So I was in the pub the other night and I got chatting to this guy who's a friend of a friend. And he goes, look, so tell me what you do. And I told him I'm a financial advisor. And honestly, his face lit up. It's like I told him I was Father Christmas or something. I've never had that reaction before to telling someone that I'm a financial advisor. Now, over the next hour, this guy proceeds to tell me with absolute conviction everything that he's learned from YouTube, from Reddit, from all the big personal finance YouTubers and influencers. Tips, strategies, the lot. And look, I could tell he's a really, really smart guy. He clearly cared about his money. But honestly, almost everything he told me was either like half-baked, half-true, outdated, or just flat out dangerous. So, you know when someone is so deep in their beliefs that it doesn't really matter what you say. They're not going to hear you. They're not going to listen. So I just sat there, nodded, and smiled politely. But what that conversation did do is give me the ammunition to make this video. Because after 15 years of advising real people with real money, I've noticed a bit of a pattern. There are a handful of beliefs, things that feel totally logical, things that the internet treats as gospel that are quietly costing people thousands of pounds. And today, I want to walk you through the biggest ones. These are the most brutal money truths that almost nobody wants to hear. And chances are, you're probably following at least one of these right now. So let's start with the one that gets most people fired up. So there is a whole world online, and I mean an entire subculture obsessed with the concept of dividend investing. Now, the idea is super simple, right? You buy shares in big, reliable companies. They pay you cash every few months. Passive income, money for nothing. Sounds like an absolute dream, right? Well, here's the problem. And this is the first brutal truth that absolutely nobody wants to hear. And it causes so much divide. Dividends, I'm going to say it again and loudly. Dividends are not free money. Let me explain with a story. Imagine you've got a house worth £300,000 and you decide to take £30,000 of equity out of that house. You remortgage and pocket the rest as cash. Has your wealth actually increased? Of course not. Your house is still worth £300,000, but now you owe £30,000 on top. You've just moved money from one pocket to another. And that's exactly what happens with dividends. When a company pays out a dividend, the share price drops by roughly the same amount. Spooky, that, isn't it? You've got the same money, the same value. It's just been split up between all being in shares. So in this case, let's see, look, £300,000 in shares. It pays a £30,000 dividend. Guess what the value of your share portfolio is going to be after that? 270. It's just that now you've taken it from it being all in shares to being shares and partly in cash. Now, this is where this gets properly painful. Even if you understand that concept, this is where it gets more painful for investors. The dividends allowance has been slashed to just £500 a year. So if you're holding your dividend stocks outside of an ISA or a pension, you are triggering a tax bill every single time you get paid, pretty much. You're literally paying tax on money that isn't even a real inflation gain. Talk about a kick in the teeth. Now, I can already hear some of you going, but my dividends are in an ISA, so that's totally fine. Yeah, all right, fair enough. But this bit applies to everyone. And it's the part that really, really winds me up. And I think this is the biggest flaw, if anything. When you are a dividend investor, what you do naturally is you only invest in companies that, you only buy invest in companies that pay big dividends. You've seeked out an alienated part of the market to invest into. You're cutting out hundreds, thousands of other companies that maybe are plowing their substantial profits back into growing their business. Like, think about it. Some of the biggest winners on the stock market over the last 20 years didn't pay a dividend for ages, if at all. They put all of their money back into research, expansion, hiring. By chasing dividends, you are shrinking your pool of potential winners, and you're paying more tax, and you're missing out on the best performance. Is a double, triple hit, in my opinion. I really do not like the principle of people seeking out investments and investing into companies purely on the basis of dividends. I understand the psychological win, potentially, that it has by seeing money land into your account. It is just suboptimal on every single level, unless you're actually going to spend that money and it's a genuine income strategy. The principle of dividend investing for growth and accumulation is just poor. So what should you do instead? Well, focus on total return. That's your growth and your dividends all put together. Own a fund that tracks the whole market if you're investing in the equities, so the global stock market index fund, for instance, and just let that do the heavy lifting. Don't box yourself in just because a company pays dividends. And yeah, you guessed it, that bloke from the pub, absolutely avid dividend investor. He was convinced that it was free money, that it was the safest strategy going. Now, that first truth winds a lot of people up, and I'm sure there'll be people in the comments telling me why I'm so wrong about it. But this next one, this is the one that keeps me up at night, because I've sat across from people who've built their entire retirement around just like one number. And I've sadly watched it kind of all fall apart as well. If you've ever Googled, how much do I need to retire? I bet you've come across the principle of the 4% rule. The idea comes from a study done in the 90s, I think, from a guy called Bengen. And it basically says, save up a big enough pot, take out broadly 4% a year, adjusted for inflation moving forward, and your money should last you 30 years, or for a normal retirement. Now, people treat that rule, or not rule, people treat that study like it's carved in stone, like it's a law in physics. But here's the second brutal truth. Treating the 4% rule as a rigid law is genuinely risky. Why? Because, and this might sting a little bit, majority of the time, the person watching this right now, it wasn't built for you. It was based on US market data during a period of massive economic growth. It doesn't account for figures about inflation and platform fees and the fact that markets don't move in a straight line in today's world. There are 1,000 flaws with the 4% rule. Now, let me give you a picture of what I mean. Imagine two people both retiring with £500,000, both withdrawing 4% at the start. That's £20,000 a year. Now, person A retires and the market goes up by 10% a year. Then it crashes in year 3. Their pot had time to grow before the dip. Now, they're laughing. Their retirement's going great. Like, look at their line. It looks brilliant. Now, picture the opposite. Person B retires and the stock market immediately crashes 20% in year 1. They still pull out their £20,000 because that's what the 4% rule told them to do. But now they're selling investments at rock bottom prices. They're selling low, not what we want. Their pot never recovers. Same starting amount, same withdrawal rate, something completely different in terms of outcome. This is called sequence of returns risk. And honestly, you need to learn about this massively. The point where you start going from accumulation to decumulation, i.e. just relying on your pot to pay your income. Sequence of returns risk. It's one of the most underrated and silent wealth killers that nobody talks about. And this isn't just theory, by the way. Vanguard, one of the biggest investment firms in the world, did a massive study in this. And what they found was simple. If you are flexible with how much you take out each year, your money lasts longer. This is something that I do with all of my clients, okay? It's an adaptive withdrawal rate. Even if you retire right into a crash, this works. So if you're planning on retiring in the next 10, 15 years, this applies directly to you. So look, as I've said, the 4% rule is a brilliant starting point. Brilliant. It's the logical line in the sand that you start, okay? It gives you a target to aim for. But when you actually retire, you need a plan that bends without breaking. In the bad years, you put out a little bit less, maybe 3% instead of 4%. And you keep some cash set aside so that you're never forced to sell your investments when the markets are in the toilet. Essentially, just having the ability to adapt to your withdrawal rates based on the initial amount is what will absolutely save you. And here is what absolutely kills me. You know why the 4% blows up for so many people? Because they've got their entire pot invested in one asset class. Equities, the stock market. No cushion, no buffer. When the crash comes, and it always comes, let me tell you, they are fully exposed to its brutal downsides. Which brings me to the third brutal truth. And honestly, this one genuinely might be the most dangerous one of all. So right now, the loudest voices in personal finance are all pretty much saying the same thing. Put everything of your investment into stocks, 100% equities, S&P 500, global index fund. Ignore the noise, stay the course, and you'll be rich. And look, on a spreadsheet, over 40 years, they're not wrong. Stocks have historically beaten every other asset class. But here's the third brutal truth. Personal finance doesn't happen on a spreadsheet. It happens in your head. And your head does stupid things when you're scared. And this brutal truth is the one that I've seen cause the most real world damage. Let me tell you about a guy I was working with. I think he was 55. He was planning to retire at 60. And he had £500,000 in his pension invested 100% in equities. Now, that was totally fine for a long period of time. He'd done really, really well. The market was absolutely flying. He was buzzing. And I was having conversations about de-risking and doing all this sort of stuff. And he just kept saying, I've got a high risk tolerance. I can handle anything. Then, good old March 2020 happened. COVID. Markets dropped about 35% in a matter of weeks. His 500,000 became 325,000. Just like that. Super quick. And I'm sitting across from him on a video call and all the color is drained out of his face. He goes, I need to sell. I need to get out before it goes to zero. Now, I managed to talk him off the ledge of not doing that. He still thanks me to this day, by the way. The only reason we could is because we built in some bonds as a cushion. If he'd been in 100% stocks, there's no talking anyone down from that. The panic would have been unbearable. And the data backs all of this up. Latest research found that the average investor earned almost 8.5% less than the market last year alone. And they've underperformed for 15 years straight. Why is that? Because everybody buys high and sells low. They panic at the exact wrong moment. And sitting across from that guy, watching him want to throw it all away, that's when I realized the actual question isn't how do I get the best returns? It's how do I get returns and an experience that I can actually live with? That's something that professional investors have a name for. It's called risk-adjusted returns. Basically, how much return are you getting for the amount of stress and volatility that you're putting up with? Think of it as like driving down the motorway or driving in general. You could do 90 on the motorway and get there 10 minutes faster, or you could do 70 and arrive relaxed and alive. The difference in arrival time is tiny. The difference in stress is massive. And that's what not being 100% in the stock market, that's what it does to you. So only be invested in things that are suitable to your level of risk in terms of capacity for loss and how you individually think about risk and who you are as an investor. Add maybe something like 15 to 20% of your money into solid government bonds, or hold it in cash, or into a lower risk asset. The maximum growth will dip a tiny bit, but the ride that you experience, it will feel way, way smoother. The crashes feel less terrifying, and you're far more likely to stay invested throughout those rough patches. And that's the real point, isn't it? The best investment strategy is the one that you can actually stick to, not the one that looks best in theory. Maximizing returns is pointless if the volatility shakes you out of the market at the wrong possible time. Now, I've got a bit of a confession. Everything that I have just shown you, it only really works if you've got a solid financial base and a foundation. And that's the part that most people skip. They jump straight into investing without getting the basics right first. It's like trying to build a house on sand. I've seen it wreck people's finances over and over again, which is why you should really watch this video here next. I break down the exact order to achieve financial security step by step. Get this wrong and none of what I've just shown you matters. So give it a click and I'll see you there.